Alright, so this is the next step. This is, the sectors and all that stuff. So I'll start. Here you see what he says. Having completed our study of the composite average. What is he saying? Step one, you gotta use a composite average. And by that, he just means basically the SPY. You use a SPY if you're a stock trader, the ES, NASDAQ, or YM if you're a futures trader. I don't know what if you're a forex trader. But yeah, this stuff works on commodities as well. So any metals index, whatever you want. But predominantly, it's what he's doing is he's putting things in your favor. So the first thing is the market has to be in your favor. Why? Because the old saying, "Rising tide lifts all boats." So an uptrending market lifts all stocks. It's kind of like that. Anyway, after that, what you want to do, the next step. What is the next step? So we're kind of building a method here. So first is you're gonna trade with the trend of the market and analyze it as well and see its position. Uh, right now, I haven't done all that. Just the analysis of the market using the first study, right before this. But now the next step is to take a look at those sectors and groups. All right. So it's a step-by-step, very methodical approach that Wyckoff puts together. He just fucking can't teach it because he uses an approach that nobody understands. And I don't know. So, having completed our study, the next step should be acquire understanding of group behavior. So the group behavior is talking about the groups, the industry groups. What industry groups? We'll get into that, but you have to do the sectors as well. I mean, go through the sectors and the groups. Why? Because I don't know why. It's just that's what you're supposed to do. All right, but you got to know the groups, industry groups. So what does he mean by that? It's like, okay, so let's say you're taking a look at the SPY. After that, say you were looking at healthcare. So I think it's XLV, if I'm not mistaken, is the healthcare sector spider. So you take a look at the sector spider for healthcare. Then you take a look at the industry group. What is the industry group? It could be your biotech. I think biotech is within. Yeah, of course, obviously it's in there. Then, or you could take a look at medical device makers, or it would be the probably the insurance providers. I forgot the rest, but that's the idea. The overall market, the sector, then the industry group. Once all of that is aligned, then you're picking the stock. It is a bit arduous, but you get the hang of it, and it's a very, very structured methodology. Um, and that's why, like, I really don't agree with adding anything on top of the method. Even those additional indicators that people that even quote unquote Wyckoff indicators and stuff like that, adding all that, or looking at this index or that index or the breadth indicators and all that. You're crazy. How much stuff do you you'll have to coordinate? You just get confused and it's unnecessary. So after we examine the position of the trend of the various groups and finally select from the best situated groups those individual stocks which promise the best moves. How do you know they promise the best moves? A, relative strength. B, nice base. So when the market's going down and your stock isn't, ask yourself why. It's because someone's holding it up and it's kind of like basing out. So then it has a very nice chance of exploding. Okay? When the market reverses again up, that stock has a tendency to go up even higher because it's holding. People are buying the dip. If your trend charts are made, oh lord, forget this. So all you want to do is kind of like overlay them. Don't make like over here. What he's doing, he has steel, and he has the times average, right? One of the best indicators of the future course of a group or stock is its comparative strength when the rest of the market is weak, or its comparative weakness in a strong market. This is exactly what I just said. Market goes down, but the stock doesn't. What does that mean? It means when the market reverses back up, that stock is going to fly. So here you have it. One of the best indicators of the future forecast, what's going to fly fastest and furthest of a group or a stock. So it's both. Alright, it's both. Is its comparative strength with the rest of the market when the market is weak, and it isn't. Alright. James R. Keene used to say, watch the stock that shows strong resistance to pressure when the market is weak and buy those stocks for all you are worth. This is how strong this concept of comparative strength is. And you don't have to be a rocket scientist to do this. I mean, as you can see, the market is weak here, right? The bottom chart, and making lower lows. And what's steel doing? It's holding. So this is comparative strength, right? And look what happens. You see what he did? This line here, one of the best indication of future course of whatever, is this. Look at this markup. So market goes down, but this stock or industry group doesn't. And eventually, when it goes up, here, this piece of shit high, look at how this one moved. You see? This is the power of comparative strength. When properly understood. Now, obviously, not all of them are going to look like that. And this is a bit of maybe probably a cherry-picked example, but it will move. You know, if you take a look at some of these NASDAQ stocks and compare them to the Dows, it's a night and day difference. They move with crazy volatility and get into a momentum state, right? So the reason for this, someone is trying to buy when the market is weak. So that's why it's not going down. When the market is going down and stock isn't, it's because someone's buying. They're buying the dip. Who? The CM. He would not do this unless he has a reason to believe he can sell it later at a higher price. So he takes advantage of the weakness in the rest of the market by holding the bag for all the sellers. Basically, someone's buying that pullback. And they're buying that pullback for all it's worth. And why are they buying the pullback? Because they know that's a good price. Because when the market reverses, that stock is going to go much higher and they'll make a very nice fat profit. When a stock, however, is exceptionally weak in a strong market, we conclude that somebody knows something to its disadvantage and is forcing its offerings on the market. So if the market pulls back and the stock pulls back a whole lot more, that's the opposite. Someone's just selling and this may be because of urgency, fear, necessity, or whatever. The stock responds feebly to rallies and advances the market, but sinks rapidly. Alright. Large operators often test the market for stock by buying 5,000 to 25,000 shares in order to see how easily they can buy it, or by selling a similar quantity as ascertain whether the market will absorb their selling. Well, that's how they test. One way to test, you drop a whole lot of volume and see if the stock is going down or not. If it's not, that means someone's buying the dip, right? Thus, they are able to decide which side shows least resistance just by throwing a lot of stock down or up. They'll know which way the price moves relative to the pressure, relative to the volume, relative to the pressure of that volume, which side is easier to move. This is a little bit I don't like to get into this too much because it's a little bit complicated, and it requires a lot of skill. When they're doing all this, it's better just to wait until it finds it and then just get in on pullback. It's pretty easy to get in pullback. Stock is rather scarce. They regard it as a bullish indication and take a long position. If it yields easily to pressure, they regard it as bearish. Easily to pressure meaning the volume is able to drop that price. A small operator is unable to test the market in this way, but by a close study of his charts, he is able to estimate the comparative strength or weakness of a stock and thus reinforce his judgment as to whether, considering the trend, it's time to buy or sell. When large interests are planning a campaign in a stock, they lay the foundation. What do I mean by lay the foundation? They accumulate or distribute a quantity according to the size of their venture. This is the foundation of cause and effect, in my opinion. This right here, read this carefully. When large interests are planning a campaign, right, that cause, they lay the foundation. That's the cause. Alright, laying the foundation is the base. When you hear about the base and then the move up, that base, that is, they accumulate or distribute a quantity according to the size of their venture and the anticipated profit to be derived therefrom. Okay, this quantity bears a relation to the estimated number of points profit. This is the foundation of cause and effect. If they accumulate a lot, it's because price is going to go higher and higher and higher. It has to, because they have to sell slowly as on the rallies. So you sell some on 10% profit, then you sell another on 25% profit, then you sell another on 40% profit. You need it to go higher, because if you cannot dump all of it at once, if you dump all of it at once, it's going to screw up the price and attract sellers. So here you go, foundation of whatever, of cause and effect. Figure charts afford a means of judging this relation and hence frequently indicate the approximate objectives of such campaigns. And I will be going over this figure chart, so please pay attention to it. See over here? Market went, broke out, came here, tested, ding ding, higher lows, higher lows. Why is higher lows? Supply is diminishing. And bang, breaks, tests, and flies. So, anyway, I'll get into all that later. Alright, next, if a stock is below value and these interests see a large profit ahead, they will take all they can and buy at certain levels. You've seen what's going on in the oil stocks, right? Like, are people going to stop using oil because of Tesla? No, obviously not. Then gradually raise their bid prices until they get all they want between letters A and R, shown this graphically. They buy preferably on reaction such time as they are ready to mark up prices, or they buy we'll get into this, how they buy at levels. And they buy preferably on reactions. How they buy on reactions, right? Notice this is also a hint, because they reaccumulate or they accumulate on reactions. Say buy on reactions, accumulation on reactions, and reaccumulation as well. And such time as they are ready to mark a price, or if the stock is above value, they see trouble ahead, they will sell all they can at certain levels, supporting the price on reactions and unloading on the rallies until they are ready to let it drop. This is why the supporting points and points of resistance are so important for you to watch. support and resistance was coined by Wyckoff. You hear support, resistance? Where did it come from? It came from him. Anyway, what was I saying before? Or if a stock is above value and they see trouble ahead, they will sell all they can at certain levels, supporting the price on reactions and unloading on rallies until they're ready to let it drop. So being able to see this, like how when they're unloading on rallies, is important. Being able to see when, bottom line is like, it's just saying unloading on the pullback. So if from the short perspective, this is just like selling halfway back. Okay, that's what he's saying over here. Also important for you to watch the support and resistance point. In brief, when you see strong support in a stock and the rest of the market is weak, you know the buying is better than the selling. That insiders are probably doing the buying because they believe they can sell out later at a profit. And when you see the reverse, that is a strong resistance in a stock with the rest of the market advancing, you know selling is better than the buying. Okay, insiders are selling because the outlook for that stock is turning sour, or because they believe they can later reaccumulate at a lower level. Okay, when you see these indications on the tape or chart, follow them. That is, select the best of them if there are many. To do this, you have the insiders working with you and for you. Yeah, so that's what the point is. Comparative strength will allow you to use the insiders on your side. And this is an extreme example here, but this obviously you're using the insiders on your side here. This thing has comparative strength and it's gonna fly. Likewise, when an individual stock in any group is stronger than the average of that group, okay, this is an indication that such a stock is likely to move sooner and faster than the average. This is why we're going to do this. So the idea is basically just go with the sector spiders first and say, alright, what's strong? Healthcare is pretty damn strong. Now let's go into healthcare and see which industries. Alright, so the healthcare providers are strong. Okay, let's take a look in there. Why are those provider groups strong? Why is the healthcare insurance company strong? Okay, it's probably United Healthcare. Let's take a look at United Healthcare. Yeah, it's going to explode. Why? Because it's not falling. Comparative strength, and it's going to fly. It's stronger than the average of the group. This is an indication that such a stock is more likely to move sooner and faster than the average, and further also, provided its behavior otherwise confirms the indications. Alright, so why is it going to move faster and further and sooner and all that? It is because the insiders are buying the dip. If they're buying the dip, you're going to use that to your advantage. Alright, they're buying the dip, so you buy the dip. Why are they buying the dip? Because they're buying the dip with the idea that this thing is going to fly and they'll be able to sell it at a very nice profit. That is why they're buying the dip. That's why you're following them and buying the dip too. The fact that an individual stock may be moving against the trend of its group does not destroy or impair the value or effectiveness of the indications given by the average in which it is included. On the contrary, such action of itself frequently conveys significant information which should not be ignored with respect to the behavior position of that stock. In that manner, comparing the behavior of the various group averages with the action of the whole market, the way they respond fail to respond to advance and decline rallies and reaction in the composite average. You may gain valuable additional information on which to base your stock market campaigns. These comparisons are especially important because they help you to select the best opportunities and avoid the slow movers, thereby being efficient. So what is he saying again? You just being efficient, and also they should have said this, but basically you're putting the risk reward more in your favor, especially the reward angle. Bear in mind that all stocks do not move at all times in harmony with the prevailing trend, nor they rise and fall together. Bull markets usually begin with advances in leaders, that is, the seasoned, high grade, and higher priced issues. Okay, like Apple, which what happened with Apple during this bull advance? We all saw it. Basically, tech led the entire bull advance, and Apple was the leader. Anyway, bull markets usually begin with advance on the leaders, that is the seasoned high grade and high priced issues. High priced Amazon, you know. This is so because the big interests who are best informed for approaching recovery dominate these stocks and hence reflect their sentiments toward the market by their operations in the leaders as bottom line, they influence the market using these leading stocks. It's just using the big boys. They'll use Amazon to influence the rest of the market. They'll use Apple to influence the rest of the market. Apple has influenced the market totally, like last I don't know how many years. It's dominated. Then it took a break. Now it's back. So it's dominated the market for like I don't even know so many years. And Amazon doing its thing. As the rise in the leaders continues, large independent operators taking cue from the action of the leaders are encouraged to begin bullish operations in the secondary issues and specialties. Here's the thing. The big boys, the generals, will influence the market, and then the lesser known stocks like they're not that big companies, they're a little bit smaller, they're cheaper, they're the type of mid cap maybe or stuff like that, those they'll move afterwards. So this is also important because if you have your eye on Apple and you have your eye on the other leaders, like the secondary issues will follow them because they're influenced, because their operators are influenced by the larger operators. They follow. Even with operators, they follow. They're like herd. That herd mentality is within those operators as well. Alright, operations of the secondary issues. In due course, the public is attracted by bullish demonstrations in various parts of the list and by revival of market activity, whereupon the lower priced and more speculative stocks, again, lower priced, more speculative stocks, come into line. So, like a $5 stock. So, it makes sense. I mean, when the public comes in, they usually speculate with cheap stocks. So, thus, demand rotates from group to group. For instance, from steels to rails to coppers, and from one stock to another. Not the way, this idea of rotation. Yes, it goes from, group to group to group to group. But it also goes from the leaders to the second grade and the third sucky stocks and the cheaper stocks. There's some type of follow the leader analogy is the best way to do it. Like if one Semiconductors is moving, Apple's going to move, then the cheaper semiconductors will also start moving. So they're being influenced by the bigger semiconductors. And when the public, more and more public gets involved, then like the shit stocks like that are under $5, really really cheap, they're gonna move too because, and you can see that now like what happened with many of the cheaper stocks, they just flew before this pullback. By the way, as the rise progresses, individual stocks and groups of stocks that have advanced too rapidly may rest and react, while other stocks and other groups are brought forward. Thus, bull markets are built up by the process of rotation. That is, demand shifts from week to week, day to day, and even hour to hour. We're 19 and 21. So let's see. Here you see what? This one broke out. So price moves tendency becomes increasingly selected. Price movements tend to become increasingly selected after prolonged advance, because when the big fellows see that some industries have about attained maximum prosperity, they will wind up their speculative campaigns in those groups and turn to the laggards in which there is still room for improvement. Yeah, I mean, if when large interests are distributing at the top of the intermediate or major swings, or on the way down from the extreme highs, they sometimes fool the public by rapidly marking up prices for a few easily influenced stocks, or by applying hypodermics to few of the leaders. These whooping up tactics maintain the atmosphere of bullishness so the public can keep buying while large interests continue to distribute. Alright, so don't understand that a lot of times the leaders will continue to go up, but they're going up. Even though they're going up, what's going on? Selling. So, so they're used for influencing, and they're also used for keeping a bullish environment, like sentiment. So yeah, leaders can be used to influence, and leaders can be used for influencing sentiment. An indication that demand is being exhausted may be given when the majority of stocks respond sluggishly to such whooping up maneuvers, or when they tend to fall back quickly on repeated attempts to continue the process of rotation, or when the leadership advance, or when representative stocks feel strength in a few hypodermically stimulated fast movement. The process of rotation operates in much the same manner and begins during the course of a bear market, that is, rotates to break down prices in one section and finally exhausts. How much more is this? think I'm going to stop right here. So 8M, page 5M.